Today I want to analyze AMD. It's a global technology company that designs and produces powerful computer chips. These chips include processors for personal computers, gaming consoles, data centers, and also artificial intelligence. If we take a look at the stock price, we can see we are down around 50% in 1 year. So this looks interesting, and we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is the market cap of 163 billion US dollar. So this is the seventh largest semiconductor company by the market cap. We can see we have still a lot of space to grow if we want to reach the level of Nvidia. The first thing we're looking for is revenue growth in the last 5 years, because we want to invest in a growing business, not a declining business. So we can see here the revenue was around 9.76 billion US dollar in 2020. This was a 45% increase from 2019, so very strong growth. Then in 2021, we have the 68% increase, very strong growth again. Then the 43% increase in 2022. And then we had the revenue decline around 4% in 2023. And then we had the comeback again, around 13% growth in 2024. So overall, we had the revenue growth in the last 5 years. So this is a check here, I would say. And we also have to mention now the growth is slowing down. It's not so high like before. In 2021 and 2022, it was very high. So overall, we need to check this as well. The revenue growth is slowing down. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 0.78 billion US dollar. This was a 181% increase from 2019. Then we had a strong increase again in 2021 with around 314%. Then in 2022, we had a decline around 3%. 2023, we had a decline around 64%. And then we had a strong comeback in 2024 again with an increase of 114%. So overall, what can we say? We had a free cash flow growth in the last 5 years. So for me, it's a check here. But we also had some decline in 2022 and in 2023 as well. What we also can see is the gross profit increased in a good rate. It was around 4 billion in 2020, and now it's over 13 billion in 2024. We can also see this company is spending more money on research. It was around 2 billion for research in 2020, and now in 2024 it was around 6.4 billion. So this is a very good rate. It means this company investing huge in the future. And we can also see the gross profit margin increased from 44% in 2020 to 53% in 2024. So I think this indicates that this company is getting more profitable. But we can also see the free cash flow margin was the highest in 2021, around 19%, and now in 2024 is at around 9%. So overall, I think this indicates that this company is investing huge amount of money in the future. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. If it's under 4%, it can indicate that this company is overvalued. So what we're going to do now, we're going to take the free cash flow from 2024. This is around 2.4 billion. Then we're going to divide it with the current market capitalization of 163 billion. And then we're going to get the free cash flow yield for 2024. So the number we get is around 1.47%. So this can indicate that this company is currently overvalued, but we also need to consider that they can grow the free cash flow in the future as well. So with the current free cash flow yield, this company looks overvalued, but we also should make some assumptions for the future. So if we take a look, this website here says that this company could have a free cash flow of 6.7 billion 2025, and 2026 around 7.9 billion, and in 2027 around 11.3 billion. So also if we take a look at ChatGPT, we can see they have similar assumptions, around 6 to 7 billion in 2025, around 7.5 to 8.5 billion in 2026, and around 13 billion in 2027. So overall, I think this are very high assumptions for the future. I think we should take some more pessimistic numbers, so maybe around 7 billion in 2027. I think this is more realistic. So if we take this number, we take the free cash flow here around 7 billion, the market cap around 163, and then we're going to get the number of around 4.29% for the free cash flow yield in 2027 if we assume that they can reach a free cash flow of 7 billion. So this is already looking better. It's not looks extremely overvalued right now. So with the current free cash flow yield of around 1.47%, it's not a check here, but in the future the free cash flow can increase as well, so it could reach over 4% in the future. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take the long-term debt in 2024. It's around 1.7 billion. Then we're going to add the short-term debt as well. So the short-term debt is around 0.75. And then we're going to divide it with the current free cash flow of around 2.4 billion. And then we're going to get the debt to free cash flow ratio. So the number we get is around 1.02. So this means in a little bit over 1 year, we can pay back the debt with the free cash flow. So this is a great number. It's a check here as well. And now we're going to take a look at the cash on hand. So how much money this company has in the bank. We can see here is around 5 billion. So this is a good number as well. This company can use this money to invest in the business. So we like to see that as well. The next thing we're looking for is the enterprise value to free cash flow ratio under 25. So this can also indicate if the company is undervalued. The lower the number, the more the indication for undervaluation. So what we're going to do now, we're going to get the enterprise valuation. So this is the current market cap of 163. Then we're going to add the debt as well. So the debt was around 2.5. And then we're going to minus the cash that we had. So this was around 5 billion. And then we're going to divide it with the free cash flow. So this was around 2.4. And then we're going to get the enterprise value to free cash flow ratio. So first for the enterprise valuation, 163 plus the 2.5 billion in debt minus the 5 in cash. This would be around 160.5 billion. Now we're going to divide it with the free cash flow of around 2.4. So the number we get is around 66.87. So this is a very high number, which can indicate that the company is currently overvalued from this current financials. So it's not a check here, but I think we should make an assumption again with the free cash flow of around 7 billion. So what we're going to do now is we're going to take these numbers again. We're going to take the current enterprise valuation, and then we're going to divide it. So the 160.5, and then we're going to divide it with the free cash flow of 7 billion. So then we're going to get the assumptions for 2027. So the number we get is around 22.92. So this is a better number actually. It's under 25, which could indicate an undervaluation. So in the future, if the free cash flow can reach 7 billion, I think this company can be a good buy right now. The next thing we're looking for is the shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we can see here the shares outstanding increased. So they didn't buy back their own shares. But actually, I think it's not a bad thing, because this company still wants to grow and needs to spend a lot of money to invest in the future. So I think it's not a problem that the shares outstanding increase. And we can see here as well, it's not increasing in a very high rate, around 0.19% in 2023 and around 0.25% in 2024. So it's not a check here, but I think that's not a bad thing. I would like to give my conclusion about this company. So let's start with the positive. So we had a strong revenue growth in the last 5 years. We also had the free cash flow growth in the last 5 years, but in some years we had the free cash flow decline. So we don't really like to see that. The gross margin growth is also looking great. So this can mean that the company getting more profitable. We also have a very good balance sheet with a low amount of debt and a good amount of cash on hand. But of course, the valuation right now still can look overvalued. We have the enterprise to free cash flow ratio around 66 with the current free cash flow. But if we have the assumption that in 2027 the free cash flow can be around 7 billion, then it would be around 23, which can indicate that the company could be undervalued then. So if you believe this company can increase the free cash flow in the next years, and especially around 7 billion in 2027, then the company can be a good buy right now. But if you not believe the free cash flow will increase that much, then this company can still look overvalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.